Financial Survival Network, helping you survive and thrive in the new economy. Go to CarrieLutz.com and sign up for 30 free micro trainings on financial survival.
The show is brought to you by Miles Franklin. When it comes to protecting your wealth, you know there's nothing better than gold and silver. And when I want gold and silver, I go to Miles Franklin because they've been around 22 years, and when you buy, they ship. For more information, go to milesfranklin.com or call them at 800-822-8080 and get a free quote. 1490 WGCH. This is Carrie Lutz, and you're listening to the Financial Survival Network. Today is April 4th, 2012. The metals, once again, are taking it on the chin, but so is every other form of investment. Here to hopefully clear things up a little bit is Ron Hera of Hera-Research.com. And Ron, welcome back.
Hey, Carrie, how you doing?
Doing well. The metals aren't, but I'm fine. How about you?
Well, I'm doing all right. I mean, as you know, I'm really not in the market for the short term. I'm really more of a long-term investor focusing on mining companies that actually are going to go into production. So I'm not really concerned about short-term fluctuations. If you look at it from a percentage basis, you see, gold off maybe 1.5% today. And you see the Dow off by 1% or more today. So we're seeing something of a sell-off. Now, I personally think the Dow at 13,000 is completely disconnected from the real economy, and I think that has a lot to do with the fact that U.S. companies are flush with cash right now. But I don't think it reflects what their earnings are going to look like for the next year.
So, what about this thing that the Fed isn't stimulating? You believe that?
No, I think that's nonsense. The Fed is stimulating right now with the continuation of Operation Twist. They're buying long-dated securities, which just infuses cash into the Treasury market and brings down the yields on the short-term bonds. And most of the lending by the Treasury is short-term. In the next 5 years, the Treasury has to turn over nearly $6 trillion worth of debt. And if you look at Chinese auction participation and Russian auction participation, and if you look at their holdings, what you're seeing is a gradual unwind of Treasury positions and, let's just say, a decreased involvement in Treasury auctions. And that means that the Fed is not going to be able to get out of this trade. I mean, they're going to have to keep participating in the Treasury auctions.
There's no way out. And we saw last year they admitted that they bought 61% of all the issues. So this year, maybe it's 70 or 75%. Either way, it's monetization, and it's the kind of monetization that eventually leads to way, way higher inflation.
Well, I agree, and there are many ways that cash that originates in the Federal Reserve can find its way into equities and into the Treasury market. So it's actually hard to say the full extent of the Federal Reserve's involvement or the full impact of Federal Reserve policies on the Treasury auctions. But I think there are multiple data points. I think if you look at them, you can see that the Fed has a pretty big footprint in the Treasury auctions, and I don't see any way of taking the foot off the gas, so to speak.
Yeah, and they're pretending to have their foot on the brakes. Well, in reality, they've just stepped up the throttle and are feeding it more and more, and that can only have one outcome in the long run. We're going to see it at some point, who knows when, and things like what are happening now are just kind of a diversion from the long-term theme and picture of which there really can't be much doubt about.
Yeah, I think that foot on the brake is really more of an illusion than anything else. I mean, it's really the Fed's talking points are what we're talking about, and it has nothing to do with what the actual policy is and what's really happening in terms of what the numbers are. I mean, we're really seeing a gradual process unfolding, bearing in mind that, for us living through this period, we see these events happening very slowly, and we don't know what might happen from day to day. But of course, in the future, historians will look back and they will see that this event was the unwind of the dollar as a world reserve currency. And there are many signs of this, like cracks in the surface that keep spreading across the surface, where we can see that as we see more countries trading in their own currencies, we see the BRIC nations agitating for greater influence over international bodies like the IMF. We see the increased internationalization of the Chinese RMB. There are many, many cracks in the surface of what used to be the dollar as the dominant world reserve currency. That unwind started in 1971. The U.S. was able to maintain that position because of the de facto petrodollar standard after Nixon, eliminated the Bretton Woods Agreement in 1971. But basically, it's now a foregone conclusion. I mean, Volcker tamed inflation in the 70s, but from that point, the system has been so grossly abused that I don't really see any way now of preserving the dollar as a world reserve currency.
And what's going to take its place? I'm not buying that another fiat is going to do it, because if there's no tie to gold and transparency, then you can just create as many units as you like, and nobody knows until the thing blows up. So there has to be, in whatever currency is used, complete transparency, so you know exactly how much is out there, and it can be independently verified. And number two, the ability to rein in and limit the production of those units. You come back to some kind of metals-backed currency, and something that right now doesn't exist. But when this thing blows up, it's going to be so bad, and I don't see that any country can really fully insulate itself from the inevitability that we're going to be back with gold, because there's a reason why gold's been the foundation of every monetary system. Every stable monetary system that's ever existed has had backing.
Yeah, I agree with that, but I would point out a couple things. One of them is that the fall of the Roman Empire didn't happen in a day, and neither will the collapse of the U.S. financial empire. It's not in the interest of any of the major players to rush out of U.S. treasuries or U.S. dollar holdings. For example, the Chinese or the Japanese or the Russians, they're not going to dump their treasuries because it's not in their interest to do that. In the same way as, if you're Bill Gates, you're not going to sell all of your Microsoft stock in a single day. To maximize the value that you'd receive in exchange for those shares, you would liquidate them over a period of time. That's exactly what, in fact, is happening with the Russian and Chinese treasury holdings. It's a slow process, and they'll be sensitive to the market price of those bonds. And so, they're trying to convert that value into real assets, into resources specifically around the world. So this is a long process, and barring a catastrophic collapse, which is a possibility, this process will take years to come. In the meantime, the situation we have now, where we have basically economic stagnation and at the same time inflation in global commodity prices, specifically oil, that situation will be prolonged indefinitely under the current monetary and economic policies of the United States.
Right. We know what we're in for, and there's things that you can do in the meantime to protect yourself, and you need to be doing it. Ron, thanks for taking time out today with little notice to come on the show and explain things. Where do we find you?
Hera-Research.com. It's Hera research.com.
All right. We'll talk to you again soon.
Thanks for having me on.